Freddie Mac came into the market with their SBL program in September of 2014 to compete with Fannie Mae. Since then, it was hard to deny that Freddie Mac has been super competitive on their pricing for multifamily properties. There's factors why you wouldn't go small balance, but typically most sponsors are looking for small balance Freddie Mac loans. They've got everything you're looking for: cheap cost of funds, long amortization versus a bank or credit union. Some of the banks and credit unions might only amortize their loans over 25 years.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Bo Eckstein. And today we're going to talk about the Freddie Mac Small Balance Lending Program and the advantages of agency debt for your multifamily acquisitions. Freddie Mac came into the market with their SBL program in September of 2014 to compete with Fannie Mae. Since then, it was hard to deny that Freddie Mac has been super competitive on their pricing for multifamily properties. I'm going to go over some sample general terms, sizes from $1 million and up. There's floating and fixed rate options, 3, 5, 7, 10-year terms. It's amortized over 30 years. LTVs up to 80%, subject to the market itself and debt service constraints. So tertiary markets are a little bit more challenging to get 80% proceeds. Debt service coverage ratios, we're looking for 1.25 and better for market rate properties. Non-recourse debt with standard bad boy carve-outs. The other advantage of Freddie is you can lock early on some of the programs. You can lock up to 120 days in advance. Prepayment penalty, yield maintenance until securitized. They also have some step down prepayment penalties depending on the transaction. We can talk about that in the future. Obviously, the advantage is super competitive pricing, early rate locks, up to 80% LTV, partial term and full term interest only. Also, supplemental loans are available, and it's non-recourse debt.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free, better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
So it's a very, very good program. Probably top 2 choices out there for anything small balance, multifamily lending. I always size it up versus bank and credit union debt. The reason you'd go probably bank and credit union is that maybe you don't qualify, you don't meet the sponsorship net worth requirements or the post-close liquidity, or the property's not occupied and at 90% occupancy levels or greater for the last trailing 3 months. There's factors why you wouldn't go small balance, but typically most sponsors are looking for small balance Freddie Mac loans. They've got everything you're looking for: cheap cost of funds, long amortization versus a bank or credit union. Some of the banks and credit unions might only amortize their loans over 25 years. So really, when a loan request comes in, we got to look at the sponsorship. We got to look at the occupancy levels, the sponsorship in general, their experience. And then we really just look, does it make sense to go to credit union? Does it make sense to go SBL, Freddie Mac? Does it make sense to go to Fannie for some reason on the property? So that's how we size it up. Or potentially, would it be a good fit for HUD? Are you planning on holding it long-term and you want a fixed 35-year rate? So there's all these different kind of scenarios that we have to kind of look at and then figure out, okay, based on the sponsorship's strategy to exit out, based on their qualification, what's the best multifamily debt for them. Thanks for watching another episode of the Investor Financing Podcast. Please like, subscribe, and share with your colleagues. And thanks for watching.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.